Okay, so I am at a coffee shop. This is how I like to do things. You might hear a little bit of background conversation and so forth from time to time, but normally it'll be just you and me. And what we're going to do today is talk about how to steal the market maker's edge and how we practice that around here at Radioactive Trading. Okay, how to steal the market maker's edge. And uh, you may have seen, like I did, one of my favorite films of the 80s when I was growing up and first learning about trading. I loved to watch a film called Trading Places. And Trading Places starred Dan Akroyd and Eddie Murphy. Eddie Murphy's character was a homeless fellow that a couple of old rich brokers decided to try and reform and try and see if they could teach him how to be a trader. So they did a really remedial presentation and showed him bacon and coffee and orange juice and so forth, and they're talking about commodities trading. And after their short little presentation, Don Amici's character says, "Hey, tell him the best part." And the best part is, whether the folks that they served, whether they won or whether they lost, the brokers got to keep the money. They got a piece of the action. And so they looked at Eddie Murphy. They said, well, do you understand, what it is that we do around here? And Eddie Murphy said, yeah, as far as I can tell, y'all are a couple of bookies. And so they nodded. Of course, they knew that he got it. Okay. What we're going to do here is we're going to show how to beat the bookie, or how to beat the market maker at his own game or her own game. Now, I did this. I got into Twitter today. It's June 23rd, 2015. So you know that unless you are watching a recording, right now this is a live presentation for everybody that's listening to me, the 57 folks that are on the line. Okay. It's live for you, and it's recorded for the ladies and gents that'll join us later. But here on June 23rd, 2015, at 10 a.m. this morning on the East Coast, I got these quotes from Twitter. Twitter was at $35.35, okay? And so I made a decision right then. And by the way, folks, this is not a recommendation, what I'm doing here today. I got to be really clear about my language here. Okay, I'm not a broker, and for that reason, I can't decide to make you broker. No, I can't make a recommendation, but I am going to show you a demonstration. Okay, and this is Twitter. Twitter was at $35.37. And if we're looking out to December, well, shoot, you know what? Maybe I can just pull up the, let me pull it up here. Okay, this was the shot, okay, this morning at, okay, 9:50 a.m. Eastern time. Right now, I think it's like 11-ish, no, 12. It's 12 o'clock, 12:04. 12:05 now, just changed p.m. on the East Coast. But Twitter is at $35.37. And if we go down, and there's a reason why I choose far away expiring options, okay? And I've covered that in other classes. But if we scroll down to, say, December, and we look at the call options, they're trading at, they're bidding at $3.90, and they are asking at $4.05. Now, by the way, I should mention this to everyone. In the upper right-hand corner of your screen, there should be an icon, looks like a camera. If you ever want to take a screenshot, just hit that thing, and it'll save it to your desktop. Okay, it'll save the image to your desktop. Okay, so here we are looking at the $3.90 on the bid. That's what the market maker has the privilege of buying these calls at. And they asked $4.05. Okay, so that's what things were trading at. Let's see. There we are. That's what things were trading at this morning. Okay, so and here's the notation that I'm going to use. It's 390 by 405. Okay, bid, ask. Got it? Okay, so if you or I wanted to buy the Twitter December $36 call right now, we'd have to buy it at 405. Now, it's possible that we could negotiate with the market maker. We'd say, hey, would you take $4? Would you take $4? Would you take $4.02? Would you take $4.04? And we can get in the spread. right? And of course, we don't actually haggle, verbally. It's just a series of mouse clicks over here, okay? But if you wanted to be certain of being filled right now on one contract of Twitter, December $36 calls, you would place an order at $4.05, okay? But if you wanted to sell the Twitter December $36 call right now, you could only get $3.90. And I don't know about you, but that bugs me. Okay, that's a 15-cent spread. That means that the market makers enjoy an edge over all the other traders. And as we know from the Trading Places movie, even the brokers sometimes they will enter into trades. Okay, but when they do, they get this edge. And that kind of sticks in my craw, I would like to have a more fair trade. Okay, I don't know about you. All right, but today's title, okay, is how to beat the market maker, how to steal legally, how to steal his edge. Here's an interesting phenomenon. Okay, the long call, the $36 long call purchase at the ask price has an unlimited upside potential. Okay, but it has a loss limit of $4.05, and we're going to look at that visually. We're going to look at it visually. It sounds like I'm being redundant there. From the Department of Redundancy Department. Okay, but here it is. The total cost is $4.05. How much could you lose? $4.05 or $405. Okay, per contract. Okay, but your upside is unlimited. Marvelous. Okay. All right, so that's the visual. You've got this little hockey stick looking graph where you have an upside that is infinite, okay, in potential, and your downside is the most that you could possibly lose is $4.05 or $405 per contract. Okay, all right, so back to the show here. All right, the $36 put option though, when you purchase it at the ask price plus the stock at the ask price equals this, $39.87. Okay, and we're going to show that from this morning. Okay, same thing. Okay, we've got the here's the $36 call prices. Okay, the bid and the ask. But if you slide over the screen here, you'll see the put bid and ask. For the put bid, it's $4.35. For the ask, it's $4.50. Okay, so what if you or I wanted to take a bullish position in Twitter? And what we could do is we could, instead of buying the call option, we could buy the stock itself, $35.37, and the put option also at the ask price, and we'll get filled here at $39.87. Now that's a lot of capital, right? Okay, but let's take a look here at what's happening. $36 is the put option strike price, which means that if the stock goes down, we can, at any time between now and December, long time, like 6 months, okay, anytime between now and December expiration, more than 6 months, 6 months and a week or two, okay, what we can do here is exercise at $36. So the most that we could possibly lose is the difference between what we're spending today on the ask price, both for the stock and for the put, the ask price, and what we're definitely guaranteed to get back. Okay, so that's $3.87. Now, how about that? The long call at the $36 strike, the bid is $3.90 and the ask is $4.05. So you can lose $4.05, but the market maker could only lose $3.90 if he decides to get into the same trade. That's the deal there. Okay, and there's unlimited upside for you both. All right, but with the married put at the $36 strike, now the cost is $39.87, but you can only lose $3.87, and you still have the unlimited upside potential. Okay, a lot of folks will say that the long call and the married put are exactly equivalent. They're not exactly equivalent. They're similar, okay, but they're not exactly equivalent. But here, as far as a portion of this is on deposit, and another portion of it is what you can lose. Okay, so it's like keeping some capital on deposit, and it's like you've only spent $3.87 for a long call position, right? When normally you would have to pony up the whole $4.05. So there's a bit of an edge there. In fact, when you think about it, even the market maker has to spend $3.90 on the bid price for this for this position. Okay, if he's going to buy a long call option, he's got to pay 390. Here you are risking only 387. Okay, all right. So does this simple act of buying stock plus a put, okay, give you the edge over the market maker? Well, yes and no. It does, and it kind of also doesn't, okay, because when you think about it, if he was to do the same thing, if he was to buy the stock and the put, he gets to buy the put at the bid price, and as we see, the bid price of that put option is 15 cents lower, so he's going to also enjoy that same kind of bid-ask spread advantage if he does the same play as you. Okay, so what I have shown you is I've shown you how to get about an 18-cent edge over folks that are just buying the call option. Okay, but I haven't shown you how to get an even bigger edge. Okay, so the market maker, if he does the same thing as you, he's also enjoying the same advantage, only a little better. Dang it. All right, so what about this? Well, we are going to learn how to steal that edge and steal it legally. Okay, we're not finished yet. All right, so let's recall the bid ask of the $36 call. Remember, it's $3.90 on the bid side. That's the buy price for the market maker, bastard. Okay, and it's $4.05 for you and me. Okay, but if you and I were to do this instead, if we were to buy the stock and the put, our possible loss would only be 387. So your possible loss is of 387 is really attractive. Okay, when we consider three things. The first thing is, number one, a call option is supposed to be bought in the first place. It's supposed to be purchased with the commensurate amount of capital on deposit. Okay, what that means is when you buy a call option, it's assumed in the pricing. It really is. It's assumed in the pricing that you're buying both the call and you're taking about as much as it would take to buy the stock, and you're just putting it on deposit in an interest-bearing account. Okay, that's what is assumed as far as position sizing. And when we do it this way, when we buy the stock and the put, okay, we set up a similar arrangement with an unlimited upside, but less potential dollar loss. Okay, a similar arrangement. We've still got the upside, okay, but we've even got less potential dollar loss. And number two, the position sizing is already figured out for us. Think about it. When you buy a long call, you can lose how much? 100% of whatever you put in. But when you buy stock plus a put option, you are forcing yourself not to risk too much of your particular account. Okay, your account is a different size than mine. Maybe smaller, maybe larger. But no matter what the size is, if you risk too much, you can get hurt. Okay, if you buy too many contracts, for example. In this case, you paint yourself into a corner. You can't possibly risk more than what is a sane amount. Okay, every stock has its own volatility signature, and when you buy more volatile stocks, you'll be forced to take a smaller position, and when you buy less volatile stocks, you'll have the latitude to take a bigger position, and that's kind of what this setup does. The position sizing is built in. Okay, and position sizing is the single most important part of your trading plan. We've covered this in other classes. I know that some folks are not familiar with this concept, but in truth, the difference between folks that win consistently in the stock market and those that finance all the others, the main thing is their understanding of position sizing. Okay, so if you haven't got a handle on this yet, it's something to get figured out soon. Okay, so the first two things make this very attractive to buy the stock plus a put option instead of the long call. The two things that make it very attractive so far is that you're going to force yourself not to risk too much. Your position sizing is already figured out. And number three, within the context of this play, you can do other trades as well. Okay, within the context of this play, you can do other trades as well. For example, you might do a bear call spread, and what I'm going to do is I'm going to actually jump over here. This morning it was available at 27 cents. Usually I wait and hang on to see if I can get 1/3 of the spread. Okay, so we'll see if that's available right now. It's a little bit later in the day. Okay, let's go ahead and take a look here. Bloop. All right, so here we are in our custom spread builder, right? And we've purchased the stock this morning at $35.37. We've also purchased at the ask price a put option at $4.50. And so the most that we can lose, whoops, hang on. Yeah. Now I'm seeing questions come in, and I will hit those. Okay, I will grab those questions. Just so you know, you are on a live presentation. All right, this is not a recording, unless of course you came to a recording. If you answered my email this morning, you are live. Okay, it's 12:17 on the East Coast right now, on June 23rd. Okay, and I will answer your questions. Okay, so here we are with the possibility of losing $3.87 or $387. Okay, now within the context of this play, let's go and take a look at a near-term bear call spread. Why would we do that? Well, 387 is as much as we can lose, right? 387 is what we could possibly lose. But what we want to do right now is we want to look at, okay, the stock is trading around 35.50, and what if I was to buy sell a call option at that price, okay, and buy a call option at this price? Now we're going to generate a credit here. Let me go ahead and sell this one and buy this one. Let's see what happens. Okay, when I press submit, we're going to generate 40 cents credit. Do you see that? We're selling this at $1.47, and simultaneously we're buying this at $1.07, so we're generating 40 cents credit. Okay, and what would that do to our risk? Well, it would make our risk lower, wouldn't it? Okay, the risk had been $3.87. Okay, now it's $3.48. All right, we've collected 40 cents. Kind of cool. Okay, now this is the December put, but this bear call spread, this is a July bear call spread. Isn't that something? Okay, all right. Now let's see here. I want to get back to this deal. If instead of being able to lose 387, okay, now we're going to lose less. Now this morning it was 27 cents, but I usually like to hold out for a third of the spread. Since it's a dollar spread, okay, I like to hold out for 33 cents or better. In this case, it was 40 cents. But even if we took this morning's play, okay, where you sell the 35s and buy the sell the 36s and buy the 37s, all right, it reduces how much we are going to spend. Okay, in order to avoid confusion, let me do that. Okay, we'll do that. Okay, July, selling the 36s and buying the 37s, and there we are. And what price would we get filled at today? We get filled at, it looks like 34 cents. Okay, so 34 cents there. Okay, taken off of the cost basis of our married put. So instead of 387, now we're risking only 354. Isn't that something? Okay, if the stock goes sideways, we get to keep our credit. If the stock goes up, well, we still have unlimited upside. If the stock goes down, we're going to lose less. Okay, what we've done here is we've robbed the market maker of his edge. Okay, there's only three things that can happen. The stock can go sideways, okay, it can go down, and it can also go up. All right, so before I explain those things, let me go ahead and take a look at the questions, okay, because they're mounting up here. All right, Don says, but you can get 30 or 40 contracts at your desired price. Oh, okay, Don has not learned the value of position sizing. Okay, Don, in other classes I've shown where it's certainly possible to do well with that kind of a play, but it's also possible to get hurt. And maybe just for Don's benefit, maybe a little bit later on, I'll show using the trade simulator tool how simply Okay, how about now? There we go. Okay, folks, how about now? Okay, folks, how about now? Can you hear me now? Can you hear me now? Yes, good. Okay. Yes. Okay. Let me know if it cuts out again. Okay. Very good. I'm not able to hear myself, which is kind of weird. I mean, I can hear myself speaking, but I can't hear myself in my earphones. But since you guys can hear me, I'm gonna be happy with that. Okay. All right. Cool. All right. So let's move on from here. Okay, so if Twitter goes sideways, if the stock is still at 35.37 in July, well, you keep the amount that you got from the expired bear call spread. Okay, if it's 27 cents, like from this morning, or if it's 30, what was it just now, 34 cents from just now. All right, you get to keep that. Okay, now if you had bought the long call only, you would have paid 405. Your time value will have decayed. Okay, one month from today, or whenever it is. I guess it's third Friday in July. Okay, when we reach that date, and if the stock is trading at the same amount, all right, the time value will have gone away, and you will have paid 405. And that bid-ask spread, that 15 cents worth of bid-ask spread, is still working against you to the tune of at least 15 cents when you go to sell. Okay, but since instead you've got a married put and you're effectively paying $3.87 for the same position, all right, it's a different story. The income method, which makes your total expense less, okay, the income method offsets some of that expense. Okay, so your value would be about what you got in for. Let's go ahead and check that on the chart. Okay, let's say that at expiration Friday, okay, or actually let's go ahead and take a look. Let's say our expected stock price is, what was it, 35.37 this morning. The stock price is at 35.37. Now our loss is only going to be 11 cents. Okay, but if we didn't have our bear call spread in place, all right, and we go to July expiration, which I'm not sure when it is, probably right around here-ish, okay, then our loss would be more. Okay, all right. So let's head back up. What we're going to do is put our bear call spread into place. Okay, and we're selling the 36 and we're buying the 37. Even at if we get filled at the ask price on the buy side and we get filled at the bid price on the sell side, all right, we're still going to generate a good credit. Okay, if the stock decides to go up, we still have an unlimited upside potential. Take a look at this red line. This red line is what we're dealing with before the bear call spread's expiration. Okay, so if our stock ends up right at 37 on expiration Friday, we're so profitable. But there's ways to manage this that I don't have the time to go into right now. But there's ways to manage this so that we take advantage of that wonderful upslope. On the other hand, if the stock crashes, we're going to lose less. We're going to make more if we're right about that stock, but we're going to lose less if we're wrong about the stock. Okay, all right, so that's kind of nice. I kind of dig it. If Twitter goes down, a long call will get devastated by the time value decaying and the adverse move. All right. But in our case, that move down is lessened by the fact that, number one, you had a better cost basis because of the married put. And number two, because of the income that you generated in the context of your married put. Okay. No, it's not as nice if the stock goes down, but nicer than the long call for sure. Okay, so let's look at the chart. What I want to do again is take a look at the chart. What if the stock goes down? Let's say the stock goes to say $30. Okay, it goes to $30, and it goes to $30 between now and end of July. Okay. Well, Our loss there is going to be $271 on the long call. All right, but same deal. The stock goes to $30 a share, and it does so by July. Oh, come on. It's not going to allow me to go further than July 17. Okay, all right. Well, since that's the expiration date of the bear call spread, we can make our decision there. Our loss is going to be less. Okay, our loss is going to be less if we do, in fact, lose. Okay, so you lose less when you're wrong and you make more when you're right. Okay. If Twitter goes up, now we're cooking with gas because your upside is unlimited. If the stock decides in its infinite wisdom that it's going to go up, well, you're not going to get hurt. You got in for a lower cost basis on the call, right? And and one thing I should mention is this, okay? Up, down, or sideways, there are adjustments that you can make that will put your stock plus put combination in a better and better and better place. We have this thing that we call bulletproofing. Your risk is reduced to single-digit % on any play in the first place because of our setup, okay? And by using the income methods, it's possible, in fact, it's commonplace, it may be reduced to 0 by repeated application of the radioactive trading income methods. Okay? 0 risk with unlimited upside is a dream play, but it's not rare. It's actually commonplace around here. We do it a lot. If you do lose a play, you don't get hurt. You don't get hurt. All right, if it's single-digit % that you could lose, but it's unlimited upside that you could gain, pretty cool. Okay. All right. So let me ask you a question. Was this class so far? All right, I haven't really gotten into, I mean, there's meat and potatoes already, but I haven't answered all your questions. Was this class so far on how to legally steal the market maker's edge and make it your own helpful? Was it? Let me get some ideas from you, okay? Let me get some feedback from you. Was this helpful? Don says yes. Don also says that sound was off for the position sizing explanation, so I will come back to that. Okay. Corey says yes. Okay, cool. And we got a whole pile of yeses coming in now. Okay, all right, thank you guys. All right, now, I want to know how helpful you found it. Okay, so for example, by the way, you're not committing to buying anything. I'm not trying to sell you something right now. In fact, shoot, I've already given it to you. All right, I've already shown you this facet, this portion of the radioactive trading method. But if you consider what you learned today, would you say that number one, you might use this idea? Might you use this idea? Jan says yes. Corey says yes. Don says yes. Got all kinds of yeses going on now. Okay, good. So so you think you might use this idea? Steve says maybe. He's not sure yet. Okay, that's fine. We got a couple more yeses. All right. Do you think you might use this idea? Number two, if you have used this idea last year, would it have been a better year? And here's what I want you to consider, okay? Could you tell me how much better? The edge that I showed you was 18 cents on the buy side. 18 cents on the buy side, meaning that you might have had to pay $4.05 for a long call option, but you would have risked only $3.87 if you bought stock in a put. The only catch is you can't trade all your capital, and that's actually a good thing. You're sort of painting yourself into a corner to where you can't lose too much. So number one, if you had 18 cents on the buy side, okay, and you coupled it with the 27 cents from this morning with the bear call spread, or 34 cents is what it would be now if you did the bear call spread. Okay, that's at least 45 cents, so that's $45 per contract worth of skew in any bullish trade. Would you like to have that kind of edge? Would you like to be able to trade knowing that you're getting a better deal than anybody else? You're actually buying at less than what the market maker would buy when you consider all the factors. Okay? If last year you made $45 more on your winning plays and lost $45 less on your losing plays, would it have been a better year? And also, if the potential to win big was left in the really good picks, would it have been a better year? Okay. All right. We're getting a whole lot of yeses. A pile of yeses. Very good. Okay. Now, what I'm going to do here is mention this. Think about what I just showed you. Okay. Just think about what I just showed you. What if I was able to share with you a way to keep your risk at any play down to 5% or less, but then still be able to apply this and 11 other income methods? We have 12 different income methods. If I was able to do that for you, would it have made a difference in your trading? Very good. We're having some really good feedback here. So far, nobody said that no, that wouldn't help. And we're getting a lot of yeses still in the question pot. Okay, thanks a lot there, guys. But if you'll also turn your attention to the poll, if you could let me know where you land on this spectrum here. Okay. No, limiting my risk to 5% wouldn't have helped, or you know what? Yeah, I may have lost this year, but this would have you know, made me lose less. Or you know what? This would have made the difference between a losing year and a winning year. Or yes, I did well last year, but I would have done even better. Okay, so I'm going to leave this pull up for another 3 seconds, 2 seconds, 1 second, and close. Okay, cool. Look at that. Okay, so 10%, but it's not often that it ends up being a multiple of 10 here, but this is how it worked out today. So 10% said, no, limiting my risk to 5% wouldn't have helped last year. Okay, fair enough. But do keep in mind, I'm also teaching you how to beat the market maker at his edge. Okay, so it may have helped. But the other 9 out of 10, how did that fall out? Okay, the other 90% of those that voted, 10% say, I may have lost last year, but I would have lost less. Well, you're better off then, yes? Okay. 30%, yes, this would have made the difference between a losing year and a winning year. And then finally, 50%, I did well last year, but would have done even better. Very cool. Quick poll. This is it, okay? How much better off would you be? I'm just going to ask, how much better off would you be? And again, you're not making a commitment to buy anything. I'm just kind of getting some feedback from you on what maybe I should charge for just this snippet of information. We're going to go into greater depth and detail, and I'm going to make a class on just this income method and the 3 different ways to manage it and the 3 different types of setup to use, including if you already happen to have a stock and that stock happens to be up. If you have a stock and it happens to be up, you may be able to do what we call bulletproofing. You might bulletproof yourself from the get-go, which is pretty impressive. Okay, so I'm going to leave that up for another 3 seconds, 2 seconds, 1 second. Oh, hold on, please. I've got to make an adjustment here. Folks, if you have the opportunity to cast your vote, go ahead. Okay, all right, very good. And let me close. And look, you know what? It looks like the same people voted in pretty much the same way. How about that? 10% said, yeah, same. I didn't have any losses greater than 5%, so go fish, you know. Okay, good. Probably you've got a really good handle on your losses, and that handle that you've got is making you a winner. Another 10% say, I would have saved or made enough to be ahead by $350. Okay, great. $350 happens to be the price of my full product, the blueprint. 30% say I'd be ahead by $1,000 more, so you could buy the blueprint for yourself and 2 of your closest friends, right? And then 50% said this would have made at least a $5,000 difference last year. Marvelous. Okay, guys, thanks so much for all that feedback. I do appreciate it. Okay, so what we're going to do is jump back into here, and I'm going to open it up for questions again. Okay, we already asked by how much. Thank you for your feedback. I do appreciate that. I want to thank everybody for today's class. And today, this is the formal end of the class, okay? But somebody had asked a question about position sizing, and my sound was off during the explanation. So I'm going to go into a little bit deeper explanation, okay? We're going to talk about position sizing, especially for the fellow. Oh, you're welcome. Okay, Amy says welcome. All right, we're going to go into a detailed explanation of why position sizing is important. Okay, here I am on the resources tab on radioactivetrading.com. And this is free resources. There's a free 2-week trial of Power Options, which is the platform that I use to find these kinds of trades and to manage them. And it's also the software that I'm using to show you these scenarios. Okay. Now, what I'm going to do here is go to the Trade Simulator tool. This is another free resource on radioactivetrading.com. And I'm going to ask you first off, before I even go, I'm going to ask you, what do you think is going to happen? Okay, let's do a leverage trade with a long call. Okay, what we're going to do is we're going to have a target return of say 66%. Ooh, that's pretty good. Let's say that you could only lose 40% if you were wrong. Okay, and your probability of a loss. Let's actually do this. Let's make our probability of a loss greater than 50%. Okay, now it's prediction time. Okay, prediction time. What I want to do is ask you, what do you think is going to happen here? You lose just a little bit more often than you win. Okay, you lose just a little bit more often than you win. But when you win, it's 26% more than when you lose. Okay, so if you started with $10,000, you invest 100% of what you've got. You buy as many contracts as you can, like Robert suggested. I think it was Robert. He said, wait a minute, can't you get a pile more contracts if you trade a long call? Oh, I'm sorry, it was Don. Okay, Don. Don G. Okay, so I'm answering your question, Don G. Okay. What do you think is going to happen? Folks, give me your thoughts. Do you think that this is a winning scenario or a losing scenario? And then what we're going to do is we're going to play it through 100 iterations and see what happens. Okay? Okay, some folks think it's a winner. Some folks think it's a loser. Some folks think that, hey, I'm going to win a little bit more less than I lose, but how much I'm going to win is going to be pretty good. Okay, so let's do the simulation. I'm going to hit the simulation, and here's what happened. Okay, we lost. We had a possibility of winning of 40%, and whenever we win a lot. Okay, but whenever we lose, about 2/3 that amount. And look what happened. We took $10,000, we ran into the ground. Whenever this simulation goes below $250, you're considered bankrupt. Took us 60 trades to get there, but we bankrupted ourselves. Interestingly, along the way, we might have mistakenly believed that we had a winning system on our hands because look, we're up 56%, but we got hurt. Okay, let's try this again. Oh, bankrupt after 46 trades. Let's try it again. Oh, bankrupt after 22 trades. Okay, all right, now Don is piping up. Okay, I was not using 100% of capital. See now, Don, you are exhibiting what many of us don't do. We don't remember to pay attention to position sizing. Now, Don is saying, I was asking, is it even possible to get 30 or 40 contracts? Yes, Don, it would be possible for you to get a whole pile of contracts for your capital. But what I suggest is that you park some of your capital. Now watch this. What if we were to simply invest only 10% of our trade? And even if we're losing more often than we're winning, and we have the same type of win-loss rules, now what we've done is we've changed over from having a losing strategy to having a winning strategy. Isn't that something? Even if we lose way too often, we don't lose too much, okay? But if we have a pretty good turnout, look at what happens, okay? It's all about losing less when we're wrong and making more when we're right. Okay, so even, yep, okay, good. So even a losing more often than winning type strategy, even that can be affected by your, by your position sizing. And what the radioactive profit machine does is it puts the position sizing into place automatically. Okay, all right. Okay, that answers my question, says Don. I just wish you use larger positions to get a cash flow. Thanks. Okay. All right. So for cash flow, there are 12 different ways to use the radioactive profit machine to take money out of a married put position. I haven't shown the sexiest ones. Okay. We did show income method number 6 is what we call it. Income method number 6 today, which is using the bear call spread. And I hope that you've enjoyed it. If there are other questions, I'll go ahead and hit them for now. Okay. If there are other questions, otherwise, what I'm going to do is clear this and close up for now. Okay. This morning it was 35.37, and this morning also we were able to get the December put options, $36 put options for $4.50. It's even better pricing now. And again, this is not a recommendation, it's a demonstration. Okay? I'm making a demonstration. Okay? So instead of risking $4.05 for every contract, we're risking only $3.87. So there's edge there. And then we're going to add another edge by doing our bear call spread, income method number 6. Okay. All right, other questions? I have the blueprint, never got income method number 12. Income method number 12 is available in a video instruction format. We are going to make the PDF available to all blueprint owners, but right now it's available in a video instruction format in the blueprint owners area. Okay. Oh, I guess I'd be remiss if I didn't tell you how to get the blueprint. Let me go ahead and do that, folks, for everyone. And while I'm pulling that out, let me just ask you, what did you think of that income method? Okay. The fact is, you can use this income method more than once. And if the stock travels along sideways, if it goes down or if it goes up, you're taking away from the cost basis of both your stock and your put option, while remaining in position to have an unlimited upside potential. What we can do is we can trickle away the cost basis to the place where we have no risk anymore. And that's an exciting proposition. Okay. Thanks, guys, for your votes. I'm seeing them roll in right now. This is the last poll that we'll do. And let me leave this up for about another 3 seconds, 2 seconds, 1 second, and close. Okay. 20% say trickle away the cost basis little by little. I dig. 40%, this one trade made it worth all the time I spent here today. Good. I would like to ask you guys what you might pay. You're not being obligated, okay, but I'm asking you what you might pay for a product that would teach just this, but go into great depth and detail. What do you think you would pay for it? Okay. 20% say, I want to know more about riskless spread trades like this. I'll show you how to get that. And 60% say, I especially like bulletproofing. Is it real, though? You know, is it really possible? Yeah, it's actually commonplace, something that we do around here a lot. Okay, so please use that question, Pon. Is this webinar available for viewing later? Asked Jill. Yes, it will be. I'm recording it now, and I will be posting it to the site later on this afternoon. You're welcome. Cool. Okay. Okay, where was I? Oh, I was going to show you how to go to radioactive trading and get the blueprint. Now, okay, for most folks, if you were to just go over here to the products tab and click that, okay, it'll take you to the blueprint and the home study kit. All right, the home study kit is simply an expanded version of the blueprint. You get the blueprint, but then you also get these audio video CDs that will go into greater depth and detail and teach you you know, audio visually. if you feel like, geez, you know, all I really want is a book to read, okay, then here it is. It's the blueprint. And then both of these products come with 2 things that are invaluable. The first thing that comes with is 100% money back guarantee. So if there ever was a bulletproof trade, here it is. Okay, you can't lose anything. You have everything to gain, but nothing to lose. The second thing that it comes with is support. Okay, so if you are a trader and you pick up the blueprints, and before you do your first radioactive trade, write into us at support@radioactivetrade.com. We'll provide a second set of eyes and hold your hand a little bit and help you to know if your position is radioactive or not, and whether or not you're going to have the expectations that you should. Okay. All right. Very good. Here's how to get some bonuses. Okay. Rather than going to this tab, go to radioactivetrade.com/iridium, the chemical element iridium, and voila, there's a new page here that includes 5 different bonuses. The bonuses themselves add up to more than what the blueprint costs. So if it were me, I would go there right now. I'd go to radioactivetrading.com/iridium and get these wonderful bonuses. Okay, folks, if there are no more questions, I'll go ahead and head out and then go ahead and close this. Yes, the webinar is available for viewing later. And no, we never do a sale. No. We charge what we need to in order to be able to provide the kind of support that we do. Okay, so we never do sales. We have raised the price of the blueprint over time, but we never have reduced it since 2007. 2007, we had a one-day sale. Never going to do that again because we ended up with a glut of customers. We had piles and piles of customers all of a sudden, and we wanted to be able to serve them all. So it resulted in a lot of new hiring and a lot of headaches. So we just don't do sales anymore. Okay. All right, folks, thanks so much for your input, feedback. Thanks for those of you that participated in the polls, and we'll see you out there. Happy trading, and bye for now. You're welcome.